Do the people, okay, here we all come. They're coming in. All right. So let's make sure everybody's in and then we'll get started. So I think all the participants are in now. So first and foremost, everyone, welcome. Thank you for taking time out of your afternoon to, you know, come to this seminar, webinar for the changes in capital gain inclusion. So, trying to respect everybody's time. We do apologize that we're a few minutes late off the hop. We did have some technical issues here, but I think we got them all resolved. Uh, in terms of the way the presentation will be structured, we have Adam Dingman. He's our moderator for today. So if there are any questions, concerns, items you want to address in the chat or question and answer section, you guys can type your questions. Adam will field all the questions, and then at the end of the presentation, we'll sort of address all of those. Now, we're going to start with Rick Bassett. Rick Bassett is our tax senior. He's a tax principal at DDL. Rick comes with a wealth of knowledge, great tax resource for DDL. Rick is going to address first the current environment for capital gains inclusion, and then the changes that are being proposed to capital gain inclusions. So Rick will go through that. Once Rick gets through the technical side of it, I'm going to take us through some simple illustrations, which will be very useful to a lot of people, just so they can really step into the example. And, as we go through this, our objective is to sort of highlight what's changing, but at the end, we'll also recommend what's best for most clients, and we'll go from there, okay? So, Rick, I just want to make sure, if you could give me a test 1, 2, 3 and make sure we can hear you.
Yep, I'm here.
Okay, fantastic. So Rick, I'm going to pass it over to you. So guys, Rick, I'll flip over to the first slide and you can get started, okay?
Sounds good. Okay, so welcome everybody. Thanks for joining us for the change to taxable gains taxation. What we're going to do first is, just address the fact that the changes were announced April 16th, 2024 in the federal budget. So there's significant changes across the board to capital gains that are being proposed for individuals, for corporations, for trusts, and so on. Today we're going to concentrate on the seminar today is concentrating primarily on the changes to capital gains to corporations. But I want to just highlight the other changes as well before we get into the corporation changes. And we're going to talk a little bit about the status of these proposals, where they stand right now. Also, some high-level advisors and so on and ourselves have been thinking about these kind of things. And we've got a few suggestions, and some have been put forward to the government that they might take up, they might not. I'm just going to quickly highlight those too as we go through. And as Tony already said, we're going to highlight some action steps that we highly recommend that you should be thinking about and perhaps proceeding with. So first of all, let's talk about the changes to individuals. That's personal tax. What's changing there? Well, first of all, we've had a lifetime capital gains exemption in place for a lengthy period of time in Canada. It has been indexed, it's been increasing every year, that sort of thing. Moving into 2024, that lifetime capital gains exemption that applies when we sell qualifying small business shares or when we sell qualifying farm property, is going up to $1,017,000 already. That was just with regular indexing. After June 24th, 2024, it's increasing to $1,250,000. So that's a good change. The government indicated that they are going to continue to index that $1.25 million capital gains exemption, but not until 2026. So it remains at that level until 26. Okay, I want to mention very quickly, there's a couple of other new opportunities that we're not going to address today in any amount of detail, but I want to just suggest them or, lay them out very briefly. One is the Canadian Entrepreneurs Incentive. This is another new beneficial capital gains partial exemption, if you will, that's going to apply on the sale of many sales of small business corporation shares, not to all, but to many. It's not even starting until 2025, and it's going to be phased in on a 10-year period. So there's going to be $200,000 per year for 10 years. So at the end of it, it'll be $2 million more capital gains partial exemption. The reason I say partial is this extra $2 million can be taxed at a 33.33% inclusion rate. So that's going to be half of what the new rate is. So it's a beneficial tax rate on another 2 million. Again, we're not saying much more about that today, but you might want to talk to your DDL contact about that in the future sometime. Another thing that's been around for a couple years is called the Employee Ownership Trust Tax Exemption. This is a big one. It sounds really exciting when you first look at it. This one offers up to $10 million tax-free on the transfer of a qualifying small business corporation. First of all, it's quite restrictive as to what corporations it applies to. And secondly, it's going to be extremely limited because it's not on a standard sale. It's going to happen when the company is effectively sold to employees and is carried on from that point forward in an employee ownership trust. So very restrictive, but in the very, very few cases that it might apply, it's very exciting. So again, if you think that might apply to you, give your DDL representative a call and talk further about it. We're not saying more about it today. So next is what's changing then for individuals? What's not brand new and what's changing for individuals? So after June 24th, 2024, there's going to be two different tax inclusion rates that can apply for individuals. First of all, any gains that are realized up to and prior to June 25, 2024 are going to remain the way they've always been. That is, we have to include 50% of those capital gains into taxable income. So you can have $1 million worth of capital gains up to June 24th, and you're still going to include only 50% of those gains. After June 24th, 2024, and for the rest of 2024, you can have another $250,000 or up to $250,000 of capital gains. Those also will be 1/2 taxed and 1/2 not taxed. If you have any capital gains personally greater than $250,000 after June 24th, then the amount over and above $250,000 is going to be taxed at a 2/3 inclusion rate. So you're going to have to pay more tax on those capital gains. So what does that mean? Well, we got to focus this, we got to pick somewhere to focus it. We can't, cover every single taxpayer and every single tax range and all that. So to make it simple, we're just assuming or we're addressing taxpayers that would be at the high rate of tax already. Now, the high rate of tax starts at $247,000 for 2024. So if you have capital gains that are going to happen after 247 or take you after over 247 of taxable income, then currently, before the new rules come into play, you're paying 26.8% on those capital gains. After June 24th, for the gains that don't qualify for the 50% inclusion rate, you're going to pay 35.7%. So that's almost 9% more in tax, $9,000 for every 100,000 of capital gains. Pretty significant. Okay, what else matters for personal taxpayers? Well, some personal taxpayers have capital losses that have happened in past years that maybe they haven't used yet. They've been available for carry forward. Well, there's an incentive to perhaps save those capital losses until, excuse me, until you're maybe going to experience capital gains at the higher rates. Why is that? Because the capital losses can be applied against any capital gains, whether they're subject to 50% inclusion rate or whether they're subject to 66 and 2/3% inclusion rate. So naturally, they're more valuable if you use them against capital gains that are going to be at the 2/3 rate rather than the 50% rate. So keep that in mind. Now, where is I don't know, planning required for individuals? Where is serious consideration required for individuals with respect to these new capital gains taxation rules? Well, one is that all of us, one day, someday, are going to have to leave this world. So anybody that's closer to that point than further away from that point needs to perhaps give more serious consideration than others maybe. Why is that? Because when we do leave the world, every single capital property that we own is deemed to be disposed of at that time. Now, that's a little bit overly simplified. If we have a surviving spouse, then we could roll all the property over to the surviving spouse. But to keep it simple, let's say we're the second one to go. Let's say one of the spouses is already gone and we're the last one. We're going to be deceased at some point in the future. When we are, everything is deemed to be disposed of at fair market value. And depending on the extent of the capital property that we own, capital gains can be major at that time. So if that date is approaching soon, some thought and some consideration is strongly considered, should be strongly considered. Sales of real estate. If we've had, I don't know, a second property, maybe a cottage, a ski chalet, something, we've got another property that we've had for a long period of time. Maybe the capital gains have built up significantly on that. So they might be well above 250,000. If that's the case, and particularly if we're thinking of selling that property or transferring it to the next generation or something soon, then consideration is strongly recommended. Maybe we have investment portfolios that we've had for a long, long time, and they've been successfully invested, and/or we've been lucky, whatever it is, and there's significant amounts of capital gains on them. In that case, maybe it's going to be difficult to fit under the $250,000 per year in terms of cashing in those investments, depending on our ages and everything else. Some consideration might be required there. Private company shares, that are not sufficiently covered by the capital gains exemption. If we have quite significant capital gains that are going to happen on these private company shares, and particularly if we're thinking of selling in the not too distant future, or maybe transferring them to the next generation, something like that. Some strong consideration needs to be given there. Okay, let's move into the area of corporate changes. So, first of all, one very important thing with respect to the changes to corporations, the date's the same, by the way. The magic date is after June 24, 2024. That's when our illustrious government has decided that they want to kick us in the rear a little harder whenever we have capital gains. And for corporations, there's no special limit that we still get the 50% on. So there's no 250,000. If we have $1 of capital gains in a corporation after June 24th, it's taxed under the new inclusion rate, the 2/3, rather than the 50%. So that means that corporations and trusts, we're kind of concentrating on corporations today, but corporations and trusts are both dealt with that way with capital gains after June 24th. They need to give some consideration now as to should something be done prior to June 25th. And we're going to do some talking about some of those considerations. So the first step is that each party, each corporation, each owner of a corporation or a controller of a trust or whatever, should be stepping back and saying, okay, what do I have that might have capital gains on it, inside my corporation or my trust or whatever? Maybe let's talk about investment accounts. So maybe I have an investment account. Maybe I've been successful over the years and I've built up a pretty healthy investment account in there and I've had it for a long time. Pull out the statement. What kind of capital gains are there reported on that statement? Now that's step one. Go right to the bottom of the list of all your assets on that statement, and it's going to show you here's what your book value is, here's what your fair market value is. And 9 times out of 10, if you've had it for a long time and you've got a decent investment advisor, your fair market value number is going to be a fair chunk higher maybe than the book cost or the adjusted cost base. The reason why I say that's only step one is because you got to look further now. So you might have a long list of investments on that statement. And I'm going to guarantee you that some of those are going to have positive gains on them. Some of them are going to have losses on them. So what you really want to do is you want to filter out the gains. So the gain that you see at the bottom of the statement, that's not the whole gain. It's going to be higher than that. So if you exclude the losses and just filter out the gains, that's number one, first part of your homework. You want to figure out how much in gains is there. Okay? Then, the reason why you want to do this, once again, it's very similar to personal taxpayers. Currently, when corporations or trusts experience capital gains, they pay tax. This is a little bit simplified, but they're going to pay tax on half the gain currently. So half goes into taxable income. Corporations, generally speaking, pay 50%. It's slightly more than 50, but say it's 50%. That means they're paying 25% on the capital gains. After June 24th, they're going to have to include 2/3, just like individuals, and then they're going to pay 33 1/3% tax. So once again, it's 8 1/3% higher, the tax, right after June 24th. So it's very important to have some of these considerations. Now, what is it that one should consider? Well, the consideration is maybe I should realize some of those capital gains prior to June 25th. What's that mean? Well, maybe I should make those gains happen. Doesn't mean you have to, sell everything and, not invest anymore. It doesn't mean that. You can sell all the gainers and you can buy them right back. If that's what your investment advisor thinks is best, buy the same things right back. And you've caused the gains to happen when you do that. Now, whenever we do any of these things, or particularly with this change in capital gains tax rates, there's a significant consideration that needs to be put into it. And it's not simple to answer, but here's what it is. What you've got to do is consider the opportunity cost, is what we call it, or I guess accounting geeks or tax geeks or whatever call it, the opportunity cost of taking this action. Now, what it really means is, we're talking about a good news, bad news story here. So the good news is that if you harvest or realize those gains right now before June 25th, you're going to pay a lot less tax than you're going to pay after June 24th. But you're going to pay the tax now. So if this didn't happen and we weren't talking to you today, you probably wouldn't be thinking of selling those investments and taking those capital gains into your taxable income right now. It would probably be sometime in the future. So once again, the bad news is whatever your year end is in your corporation, in the year that you sell or cause these capital gains to happen, you're going to have to pay the capital gains tax by 2 months after your next fiscal year end, generally speaking, unless there's some special planning that can be done and all that sort of thing. But we can't cover all that today. So generally speaking, you're going to have to pay tax by 2 months after your corporate year end if you realize these gains. But the advantage, of course, is you're paying less tax. There's a good, there's a bad. Okay. Well, do I want to do it or not do it? How do I know? Well, part of it is when would you otherwise be selling or accessing those investment accounts? Sometimes people have things in mind that they need those funds for fairly quickly, maybe in a year, in 2 years, 3 years. I don't know. So if you need the money fairly quickly, then it's a no-brainer. You want to realize the gains right now. You're going to be ahead of the game for sure. Maybe we go back to the when are we going to be deceased thing again. Maybe we're a little bit older rather than younger, maybe. And so, maybe it's a serious consideration to take some of these steps now. Very, very generally, you want to look at kind of the time frame. The other thing that's hard to tell is what kind of rate of return am I going to have? You see, because what we're really talking about, make it simple. Take $1 million of capital gains. If you sell $1 million of capital gains before June 25th of 2024, you're going to pay $250,000 in tax, assuming you don't have some other special things you can do to reduce that tax down. So you're going to pay $250,000 worth of tax. That doesn't sound good. Where's that going to come from? Well, probably it's going to have to come from the investment account, I guess. So now you're going to have $250,000 less invested. Okay. That's the opportunity cost. So I'm not making money on that 250 anymore. I did save a lot of tax, but I'm not making money on the 250. Okay. Well, if I did not do that and I left that extra 250 in there, how long is it going to continue to be in the investment account? So the longer it is, the more likely you're going to be to say, well, maybe I should just let it ride. I get it. I'm going to have to pay a lot more tax in the future, but maybe I'll let it ride. Let me be silly for a minute and make it overly simplistic. If you're not going to touch that money and you're going to be here and it's not going to be required and all that for 20 years from now, and you're making at least a modest or a little bit better than a modest rate of return on your account, you're probably better to let it ride and not sell right now. If there's any chance that you're going to want that money in, certainly in the next 5 years, maybe even close to the next 10 years, depending on what kind of after-tax return you're earning on your investments. So, and remember, it's after-tax earnings on your investments. So whatever it is you're earning, interest, dividends, whatever it is, you got to pay tax on that when the company earns that. And so to, get yourself in the same place, if you were making 5% after tax, and that's kind of a high rate if you think about it, after you pay the tax on the investment earnings. So if you're making a very good return on your investments, you're probably still close to close to 10 years away, maybe 9, 8.5, before you're going to be break even. So that's not an easy decision, but you got to think about that opportunity cost. Okay. I guess another one, we've kind of said this a little bit. Is there a desire to transfer one or more of the corporate properties to the next generation? If there is, then consideration should should be given to whether a transfer, a sale, a gift, or whatever of some corporate property should be considered prior to June 25th. Certainly, if they're in the short-term horizon, you should give strong consideration to that, to doing it sooner rather than later. There's maybe some creative possibilities that could happen for individuals and for corps. Maybe a portion of a property could be gifted, or transferred or something. You know, uh, you could give a portion. It's what, a portion. What's that about? Well, if there's going to be things transferred to the next generation or something, you could maybe bring that into play. That causes a part of the gain to happen now. So you're going to reduce the amount of the excess rate that you're going to have to pay in the future. All of those kind of things would have to be, discussed with your DDL advisor if you think that might be appropriate for you. Another thing that's going to be involved there, if you are going to do that, transfer some properties out of the company or something, what's the size of your due to shareholder account? Have you got a healthy shareholders loan account there or not? If you don't, that's another issue. Well, maybe we got to pay some tax to get the property out and so on. Okay. Okay, let's move on. What other considerations are there? Here's an important consideration. Currently at the 50% inclusion rate, so generally speaking, if a company, let's say a company experiences a $1 million capital gain, okay, what happens today? Well, 50% of that, 500,000, has to be taxed. The other 500,000 is not taxed. That goes into a special corporate account. It's a notional account called the capital dividend account. And then the corporation can pay that out. Generally speaking, not always, you got to be careful, but generally speaking, if there's no other ups or downs in the capital dividend account, then the company could take that other 500,000 and it could pay a tax-free dividend out to shareholders. So then you can bump up the shareholders loan account. So maybe you had a very small shareholders loan account yesterday. Tomorrow, maybe you got a $500,000 shareholders loan account. Now, an election has to be filed and everything. I say tomorrow facetiously. It would be a little longer than tomorrow because an election would have to be prepared. You'd have to sign it. It's got to be filed, blah, blah, blah. But, in a short period of time, you could have that tax-free dividend paid. So that's an important consideration. After June 24th, it's not 500,000 that goes into the tax-free account anymore. Then it's only 333,333. So you've got a lesser amount that can be paid out on a tax-free basis. Now, corporations should make the same consideration that I said about individuals with capital losses. So when you're looking at the investment account, I'd strongly advise, think about harvesting the capital gains, not the whole account. So you're not, investment advisors typically are going to say, oh, well, you probably want to do some losses too, right? So the gains aren't too high, and you can reduce your tax and all that. But they might not be realizing or thinking that those capital losses are worth more if you keep them and use them in the future. So, you want to focus on the gains, not the losses. And very generally, you want to save the losses for use in the future. Another serious consideration, and Tony's going to address this a little bit more after I'm finished, but use of the small business deduction. So there is a potential significant impact on the small business deduction for companies that are going to cause capital gains to take place. It's going to depend on the size of the capital gains and so on, and it's also going to depend on your current situation. But here's the basics of it. If you've got an active business company, then that means that generally speaking, you're going to have access to what's called the small business deduction. That's on up to the first $500,000 of active business earnings earned by a single active corporation or by a corporate group. If it's a corporate group, it gets a little more complicated. They've got a share. the 500,000. But let's keep it simple. There's one company, let's say, and the company is earning somewhere between 0 and 500,000 of active business earnings. They get a preferred tax rate on those active business earnings right now. Now, you don't want to be confused and think that, oh, wow, I save all kinds of tax. It's not that you're saving tax, you're delaying tax into the future. So you get to pay only 12.2% today. That's a great rate on up to 500,000. And then you got to pay the rest of the tax when you take the money out of the company later. But that might be a long time down the road, especially if you're reinvesting your after-tax earnings. Now, what's the problem with investments and what's the problem with realizing capital gains? Well, what the problem is once again, our wonderful government a few years ago has said, well, we think a lot of these hotshots that have got active business companies and they're using the 500,000 all the time, maybe they shouldn't be able to do that all the time. Maybe we should, build a wall so they can't always do that. So the wall they built was, they said, you can earn up to $50,000 of taxable investment earnings in any given year, and we'll still let you use the $500,000 small business deduction. But if you're successful enough that you're earning more than 50,000 in investment earnings, we're going to start to limit the amount of the small business deduction that you can claim. Now, whenever you can't claim the small business deduction, if your earnings are more than 500,000, or if you're not going to have access to the small business deduction, then you have to pay 26.5%. That's still pretty good. It's still better than you're going to pay personally if you pay it all out to yourself, but it's not as good as 12.2 naturally. So how does the 500,000 get reduced? Well, every dollar of investment income that you have in your company that's greater than 50,000, every dollar that's greater than 50,000 reduces your eligible small business deduction by $5. So the simple way of saying it is, if your corporation ever earns at least 150,000 of investment income, you're going to get zero small business deduction. Excuse me. Then all of your active business earnings are going to be taxed at 26.5. Now, that's still tax deferral because it's still less than what you got to pay personally, but it's not nearly as much tax deferral as 12.2. Okay, so that's a negative perhaps, depending on how much capital gains you're going to experience. One more thing about it, it's on a 1-year delay basis. So it's not on this year's investment income, it's on last year's investment income. So if you cause big capital gains to happen this year, next year, you're probably going to have a much reduced small business deduction or maybe zero. Okay, so where's the government at with these things? What's the status of these proposals? Now, again, I don't know, you might notice I'm going to keep taking shots at the government. So the government came out with these rules April 16th. And, they laid out what they wanted to do in very general terms, like we want to bump up the capital gains tax rates and so on. And we're going to give some preferences to individuals, yada, yada, some of the things we talked about already. But they didn't give all of the details at that time. Now, that's not terribly unusual. But then on May the 1st, the government came out, and of course the capital gains wasn't the only thing in the budget. There was lots of other things too. And so the government came out on May the 1st, and they laid out what's called the Notice of Ways and Means. That's what they do when they lay out the legislation and the specifics of what they're going to do with various things. Now, the Notice of Ways and Means covered most of the things that were in the budget, but guess what? There wasn't a peep about the capital gains changes. So it wasn't in the Notice of Ways and Means yet. Now, some people are kind of thinking, well, okay, maybe that means they're going to cave in to some of this criticism they've been taking. obviously business groups and not surprisingly the conservatives and so on have been very critical about these changes to increase tax to capital gains. Now, we certainly do not think that the government's going to back off from these things. Why? First of all, both the Prime Minister and the Finance Minister, since April 16th and since May the 1st, have both said strongly that they're proceeding and that they're going to come forward with the actual details and so on. They've said prior to the summer recess, okay? That's when they all go off on holidays again. And so they do that on June 24th. Hopefully, it's not going to be at the last second on June 24th that they're going to come out with these details, but we still haven't seen them yet. Okay? But expect that you will. There's various groups around that have made some suggestions and possible changes and so on to these rules that the government should consider. Hopefully, the government is considering some of these things. I'm not saying, and we're not saying that they're going to pick up on all these things, but maybe they will. Some of them are intelligent suggestions. So, one of the suggestions is, why June 24th? Why does it have to be June 24th that you're making this change? Why don't you make it January 1st of 2025? And then people have a little bit more time to think. And on top of that, investment advisors and all that, they're going to have 2 sets of reports and everything for everybody on their investment accounts. Accountants are going to have more work to do and all that, trying to figure out the before and after. And, why not June the 1st or January 1st? Why don't you do that? So anyway, we'll see if they take that up. Another one is, why are you making people race around and sell a whole bunch of things so that they can have the capital gains at the old tax rates? Why are you doing that? Back in 1994, not you, it was a different government naturally, but the government of the day also made some significant changes to capital gains rules. And they intelligently said, well, okay, we're going to give you a date. You can pretend that you sold your capital assets if you want to. So you can do that. You don't have to really sell them. Now you're going to pay the tax. If you want to do it, you're going to have to pay the tax, but you can pretend that you sold and just bump up the cost base on those assets. So you could just do it with a stroke of the pen or when you do your tax return. That's an intelligent suggestion. Maybe they'll pick up on that, but like I said, they're still muddling around and they haven't said what they're going to do yet. Maybe the 250,000 limit, for individuals, maybe that should be indexed. They didn't say whether it would be or wouldn't be. So we'll see. Maybe it will. Maybe you've got a deal. Maybe you've got a rental property, a cottage, some kind of property that you're selling, but there's no way that it can be closed and finalized and completed prior to June 25th. Okay? But if you got a solid deal on it, like a signed deal, maybe that should still be treated as if it was completed, even though it's not going to close until after June 24th. Maybe it should be grandfathered. Why wouldn't that be? Wouldn't that be reasonable? Well, the government hasn't said whether they will or won't do that yet. Trusts. It seems particularly brutal that, trusts are going to have to start to pay tax at this 2/3 rate. Trusts usually get, some degree of preferred treatment. What about graduated rate trusts are the first 3 years after somebody dies? Why would they have to pay extra tax? Why wouldn't they get maybe relief from this? Maybe alter ego trusts are special trusts. We're not going to talk about all these things in detail, but there's qualifying disability trusts that are set up for, individuals that need some financial help. Maybe they should get special treatment. Anyway, we'll see if the government considers any of those things. Yep. Now, I already said, yeah, we don't think the government's going to back off. We certainly don't have a crystal ball here at DDL. I don't think anybody does, but we don't think they're going to back off. Now, here's another prediction. There's a lot of people running around saying, well, you know what? I think those liberals, I think they're going to be bounced in November 2025. aren't they? They're, way down in the polls and all that. So we don't think they're going to be around anymore. So, maybe somebody else is going to come in, highly likely, the Conservatives and Polyev, I guess, and in November 25. And, maybe he's going to immediately move the rate right back down to 50%. Well, once again, crystal balls are not perfect. And ours is no more perfect than anybody else's, but we don't see that happening. Usually when governments change, what happen is, the government comes in and says, "Holy Jesus, look at how deep the hole is. These guys left us," and it's going to take us years to dig our way out of this. And, we're not going to be able to make any big changes right away. Normally, that's what happens, but we'll have to wait and see. The other thing, what we can see very clearly is history. We can't see the future, but we can see history. The last time the capital gains tax rate changes happened was back in 1988. Very quickly, there was no capital gains at all, no tax on capital gains in Canada until 1972. Then they brought in taxation on capital gains in 1972, and it was at a rate of 50% all the way until the end of 1987. Then in 1988, it got bumped up to 2/3, just like it is on June 25th. Went to 2/3 for 88 and 89. And then guess what? In 1990, it went to 75%. So we all paid 3/4 inclusion rate for all of the 90s. So last time this happened, it stayed in place for 13 years. So, you make your own guess how long it's going to stay high this time. We don't know. We'll have to wait and see. So our recommendation, I guess, just to repeat it, is that all corporations and trusts, particularly that hold assets with unrealized capital gains, should give strong consideration to realizing some or all of those gains prior to June 25th of 2024. Naturally, there will also be some individuals in certain particular circumstances that perhaps should be doing the same. Obviously, there's no two set of circumstances that are exactly the same in your companies out there or in anybody else's companies. So, you have to look at your own scenario and see whether you should be moving towards realizing or not. And, if you need any help with that kind of thing, and many do, your DDL contacts are here and ready to talk to you about those kind of things and to try to help you make those important decisions. So I think Tony's got a few things to cover now.
That is correct. Thank you, Rick. So Rick took all the words section of it. I'm going to take the numbers section. I'm a more numbers guy. So, when we made this presentation, as Rick stated, it is designed specifically for corporations. So we reached out to our corporate clients that have accumulated success, retained earnings, and have chosen to invest that success in the area of marketable securities. The reason we're not really spending a lot of time on the real estate or selling the business, can you get that deal done before June 25th? Well, probably not optimizing the amount. So we're not going to look at that. But marketable securities, that is an area that makes good sense to really focus on and figure out what should I do. And we're going to give you a concrete conclusion at the end here. So guys, I kind of did an illustration. I looked at the people that had registered, and we have quite a few professionals. So I did an example as if it was a medicine professional corporation. And then I did an example as if you were just a widget producer, just a typical, corporate entity that is generating income. So let's talk about the professionals. Maybe the professionals, their corporation generate 800 grand of income. Maybe their expenses are 200. So they make $600,000 after all business expenses are paid. So typically, why you have to make that decision is how much money do I need and how much money am I leaving in the company? So let's just take this example and say, you know what, this family chooses to pay $300,000 to live their lifestyle and leave $300,000 into retained earnings. And I'm also going to say, spouse one, let's say the professional is going to earn 150, the spouse is going to earn 100, and let's say they got two children, each earning 25. There's the 300 grand. Same story with the business owner, right? You're a widget producer, you build these widgets, you invoice $2 million, the operating costs are 1.4. Again, you make 600 G's, 300,000 we need to live our lifestyle, 300,000 goes into retained earnings. So that's kind of just stepping into an example. That way everybody on this call can sort of make that connection, okay? So what happens next? And here's a slide with words, darn it. Anyways, so that 300,000 of profits, if the company continues to do this year over year for 10 years, what does that mean? Well, it's generated retained earnings of $3 million. Good. So now within the company, the retained earnings, the business owner gets to choose, how do I want to invest this? Do I want to buy a business? Do I want to buy new equipment? Do I want to buy a rental property? Do I want to buy mutual funds? So that's what we're going to talk about. We're going to talk about buying investments, the securities. So let's say they buy $3 million worth of securities with this surplus retained earnings, this surplus cash that they built up within their company. And now let's, as Rick said, they had a good investor, the investment went up, whether it's luck, whether it's great advice, fantastic. Now it's worth $4 million. So we have that unrealized gain of $1 million. So now let's come to the illustration. So if we have investments that are worth $4 million, and our cost base is $3 million, then we have a capital gain for $1 million. And if it's sold before June 25th within the company, we end up still having the 50% inclusion rate. So that means we're taxable on 500 grand. And like Rick said, the tax rate for corporations are slightly over 50%. So the taxes we would pay within the company would be 250 grand. So you sell something, you get $4 million, you got to pay the government 250, okay? Now, that 250 though, there is refundable dividend tax built up of 153,000. What that means is, as we pay dividends out to the shareholders, we can reduce this taxes that we paid by this refundable dividend tax. So that's going to be important later on. So if we sell after June 24th, that $4 million with a cost of $3 million, we made $1 million. Now 2/3 is included. So our taxes are $334. So you can see that that means this change that Trudeau's doing potentially is going to cost us $83,000. So if we were to sell a $1 million appreciated unrealized capital gain portfolio, we can save $83,000 in taxes by executing it now. So we would pay $250 as opposed to $334. Okay. This second part says, okay, let's just talk about the company. So if the company made this 600 grand, and like we said, 300 got paid as wages, so there was 300,000 in profits. And if this company was a widget producer or a medicine professional corp, it's probably eligible for the small business deduction, 12.2% tax rate. So that means we would pay 36 grand of corporate taxes, And on the 300 grand of personal income, again, with that structure, I gave 150 to the professional, 100 to the spouse, 50 to the kids, and similar split up, let's say, with the widget producer, right? The personal taxes would be 86. So this has nothing to do with the sale of the marketable securities, none of that. I'm just saying in a normal year, 2024, we would pay personal taxes of 86, corporate taxes of 36. So we pay 122,000. So we make 600 grand, we pay 122,000, we pay 19%, 18.8, whatever it is. And you know what? They pick up our garbage. Our kids can play outside. It's safe. Canada's a great country. We're okay paying that rate of tax. Good. Now, if all of a sudden we lose the small business deduction, then what happens? So if we did sell that $1 million of investments, and as Rick said, if your investment income is over 150,000, then your small business deduction gets grinded down to zero. So in that example, again, 600 profit, 300 wages to the family, 300 left in retained earnings. Now we have to pay the 26.5% rate. So that means corporate taxes would be 89,000. 79,500, and our personal taxes would be 86. So you can see without that small business deduction, we're paying more. We're paying that extra $43,000 because we're not getting that small business deduction. So, okay, let's keep that in mind for a second. So now we come to the next slide, and this slide says, okay, well, that's what happens if I paid a wage. But remember when I talked about the capital gain, that you pay that 250,000 on $1 million, which is the 50% inclusion, and then the 50% tax rate. It built up this thing called refundable dividend tax. So of course, if we pay a wage, we don't get any refundable dividend tax. So we would owe that 165. But if we spoke to our business owner, whether it's the widget, whether it's the professionals, and most professionals, doctors, dentists, you know, their colleges have allowed them to have spouses own non-voting shares. So that's 600 grand. We wouldn't get a deduction if we paid a dividend. It's not treated as a business expense. So the company would show profits of 600, pay taxes at that 26% rate. So it would owe 159,000 of corporate taxes. If we still needed that same 300 grand to live our lifestyle, instead of taking it as a T4, a wage, we take it as a T5, a dividend. Now the company gets 38.33% back as refundable dividend tax. So out of that 159, the government kicks you back 115. Great. So now our corporate taxes are only 44,000. And if you take that dividend, that 300 grand, and again, we split it up the way I gave in that illustration, we would owe personal taxes of only 47,000. So here we're only paying 91,000 in taxes. So when we look at these three scenarios, if we just look at the normal scenario, you know, not factoring in the investment income, we would have paid corporate taxes of 36, personal taxes of 86, 122. If we did trigger that investment income and we lose our small business deduction and still pay wages, well, now we owe 79,000 in corporate taxes, 86,000 in personal taxes, 165. So you can see higher by 42,000. But if we did switch that to the dividend, Under this scenario, our corporate taxes are only 47,000. Sorry, the net of these two, which is 44,000. Our personal taxes is 47,000. So we owe 91,000. So you can see you're better off by 31,000. So why are we illustrating this? Well, look, if I have a problem with my roof and I call a roofer and the roofer goes up on the roof and the roofer says, hey, Tony, yeah, I figured out the problem. You have three options. Tell me what you want to do. My immediate response is, assume this house is yours. What would you do, roofer? And he would tell me what his best solution would be and why. So again, in this scenario, you should ask, if that was me, what should I do? Well, if I got $1 million unrealized gains in a corporation, and I know the government is going to be bumping the tax rate from 50% inclusion to 66% inclusion, and it's going to end up costing me 83 grand for every $1 million, I kind of want to trigger that gain at the lower rate. So yeah, I'm going to trigger that gain. I'm going to pay the taxes. I'm going to get the benefit of that CDA. I'm going to get 500 grand tax-free sitting in my CDA account, not dealing with 333. I know I got this pot of refundable dividend tax, and I'm going to maybe change my strategy for next year. So like Rick said, when you get passive income in 2024, that doesn't affect your small business rate for 2024. It affects your small business rate for 2025. So what I would do starting in 2025, I would stop the T4s, or maybe give you a small T4, $3,500, just so we could get the Canadian employment credit still on your personal taxes. But I would definitely switch your income to start eating into that refundable dividend tax. So what are our action items today? Our action items today are like Rick said, and on most of the emails, I've already, I know I've included that to say, figure out what your unrealized gains are. And a lot of people have already reached out to their investors and said, hey, I want to get my gain and loss report. And we got the gain and loss reports in a lot of cases. What you want to do, as Rick said, don't sell the losers, leave the losers. You want to get those losses at that 2/3. Leave those babies. But those gains, let's recognize them now. Get that 50% inclusion before June 24th. Yeah, we're going to take a little bit of a beating because we're going to realize $4 million in sales that has $1 million capital gain, a capital gain included in there. And of course, we're going to have to pay some taxes. So 2 months after a year, we're going to pay those taxes. But it's going to save us a good chunk of change right now. And we're going to change your strategy in the next few years from wages to dividends. And this is going to also recoup and put you in a better tax situation. Okay. So that's kind of where we're going with this. So everybody that has unrealized losses in their corporation, they got to give some serious consideration to this. I know what I would do. Prior to June 25th, sell my portfolio. Realize only the gains. Let me pay the taxes. I'll take care of that, no problem. So now maybe I have 250 less to invest. So I'm not going to reinvest 4 million. I'm going to reinvest 3,750,000. And yeah, I fronted some tax, but I'm going to be saving some tax over the next few years. And you know what? I got my ACB up to 4 million. I got a nice CDA account. Things are good. Trust me, that is what I would be doing. And if you're in the similar boat, which most people that we invited to this are in that similar boat, that's what you want to be doing, okay? So with that said, that's sort of the presentation. Now we'll sort of pass it over to questions and answers. So Adam, I'm not sure, will you moderate the questions here?
Yeah, so we just have the one question right now. So this one just came through. And maybe I'll read this out for Rick. So
Well, for the whole group, I guess, because the individuals here would want to,
Yeah.
watching would want to hear it too.
So the question is, does your recommendation to trigger the gains take into account the opportunity cost of keeping the entire amount invested and compounding the larger number? Sorry.
Okay, I think that question's probably for Tony, because I addressed that one already. I
Yeah,
could talk about it again, but I think it's for Tony.
yeah. So again, I'm telling you what I would do. Hey, it is great to sort of sit back and think, you know what, the election's coming up in October, and hopefully, maybe the PCs come in and hopefully they go back to the 50%. But the reality of it is, Rick was right. No, we don't have crystal balls. Knowing what's going on today, if I got that pregnant gain, I'm realizing it. I'm getting my CDA. I'm paying my tax. I'm making the savings over the next few years. And I think you're going to come out way better. Okay. That is my personal preference. It makes a lot of sense to me. And of course, there is a bit of a drag that, hey, I got to front the government 250. I'm not investing 4 million anymore. I'm investing 375. When you work it out, the perks of having your cost base up to 4 million, the perk of not having to worry about a further decline in the investment income creeping over 50 G's, being able to convert your wages to dividends, recoup that refundable dividend tax. There's a lot of things that support selling today, paying the taxes. I am a big advocate for that one.
Okay, I guess I just add briefly to that, Tony. By the way, I'm in the same boat as you are primarily on that one. I think what the questioner was asking though is, well, have you, not so much the election and not so much those kind of things. I think the questioner was asking, have you thought about the opportunity cost of doing that, of giving up the 250,000? And what they might be saying, I guess it wasn't included in the question, but it might be saying something like, what if I would otherwise have that invested for 20 more years? And then the 250,000 would also be invested for 20 more years.
Agreed, Rick. And yeah, I kind of understand the question. And I kind of know that looking at the situation, realizing that gain and saving that 10% today, uh, opening up that CDA to give you 500,000 tax free,
Yep.
all the same things we talked about.
Yep.
It's going to outweigh that, right? Like,
Yep.
of course, hey, if all of a sudden that 250 for somehow, some way generated you 25% return, then yeah, you know what? Maybe you're showing us up wrong. But me as a roofer looking at your problem, I'm telling you what to do.
Yep.
I would sell. I would realize. I would save absolutely today at that, 8.3%. I would build up that CDA. I would leave the losers for the future. I would then convert my salary from wages to dividends and start to recoup that refundable dividend tax. I probably alleviated a problem I was going to have in the future because I had this big unrealized gain that could have eaten up my small business rates over a number of years. And now I don't have to worry about that.
All right, we have a couple other questions coming through. A shorter question here, maybe Rick. Just the question is corporate stripping still an option? Do we have context on that?
Yeah, I don't know. Can somebody say a little more about what they mean?
Yeah, so we'll come back to that one. The next one is any chance of triggering AMT on triggering just before the deadline. So any AMT considerations.
Okay, well, the answer to that one is yes, there is a possibility if it's individuals that are triggering, but it may or may not be highly likely. It depends how much other incomes are going to be on the personal tax return, and it depends how much the capital gains are going to be that are going to be realized, even when AMT is triggered, and it certainly is possible. It's so like all these things need some thinking. So it does need to be considered where AMT is triggered. Often it can be largely recovered over the next 7 years. Now for corporations, it's totally irrelevant because corporations don't pay AMT. Is this the next one here?
Yeah.
Okay, are you reading them or you want me to read them,
Do you want
Adam?
I can read it, yeah.
Okay, well, I'll do it. Okay, this one says, with some investments in US and European companies held within an Ontario corp, is there any government clawback if we switch ownership of these shares to a new US company? Not that I'm aware of. I'm not sure what kind of clawback would be suggested there. But whoever it is, sometimes with these questions, unfortunately, I guess we don't have full interaction with the individuals, do we, Adam? No. Okay, so unfortunately, whoever asked that question, if they could call and maybe discuss it with us a little bit more, but I'm not sure what kind of clawback you're referring to, so I apologize. Okay, the next one is, can I still gift the asset to a charity with the same rules? Yeah, our understanding is that that is highly likely to be the case. As we suggested, the government for some reason is still withholding the full details of what they want to do with these new rules. But, again, here I am using a crystal ball. It's not perfect, but I would guess that it's going to be the same rules as before. And the reason for that is that, it's an encouragement for individuals and for companies to make gifts and make charitable contributions. So I would think you would still get the, get off of the payment of tax on gifts that went entirely to a charitable organization. This is the next one. Do the new rules apply to the sale of a small business? Well, yes, they do, with qualifications. So we did address that, but only very briefly, because we said we were focusing on corporations. Now, so where an individual sells a qualifying small business, yes, they do get whatever part of the large capital gains exemption they haven't yet used, and that would be up to $1,017,000 until June 24th, and then it would be up to $1,250,000 after that. And then there's further exemptions that are going to happen in the future that we didn't fully cover. So, whoever the individual is, Chris, I guess, would need to call us or call your DDL rep, and we can tell you more about that. But generally speaking, no, like you still can claim the exemptions and you can claim 250,000 at the previous rates over and above that. Now, if you were going to fully use your available exemptions and you were going to be more than $250,000 of gains over and above those things, then you would be into the new 2/3 rules. We'll move on to the next question. So Brad has a question here. It's, can we transfer a personal asset to the corp at fair market value and then post June 24 repurchase that asset from the corp? So net crystallize the gain, but long-term hold the asset, or will this transaction be, not sure, waived maybe as one just for tax purposes? I think what Brad might be asking here is, if we have a personal asset that we want to cause a capital gain to take place on, would we be able to first personally transfer that to our company at fair market value, claim the gain, report the gain personally, and then take the property right back out of the company at the same price because we want to continue to own it personally? So that's a good question. I think what Brad's saying is, look, if I'm not going to have a third party sale, can I cause a sale to happen? Can I be a little bit creative? We sort of said that in our presentation. Certainly there are some ways that you can maybe be creative. Now, Brad might be thinking about a piece of real estate. You'd need to be a little careful about some other things. There might be land transfer tax, on the way in and back out and so on. You'd have to check with your lawyer on that. So there might be some cost, but generally speaking, yes, you can do that. You can transfer to your company prior to June 25, and then you can buy it back after if you want to. So the answer is yes. Is there anything else? That's all the questions for now?
The question, yeah.
Okay.
Adam, can we come back to that other question about the capital gain strip? Or what was it again?
Yeah, it was just, is corporate stripping still an option? That was the question, but I didn't get a follow-up on that one.
Yeah, I believe we can address whoever asked that question, but I believe, Rick, there was, how people were doing the dividend strips to convert into capital gains. So instead of paying 33%, they're paying 25%, save the 8%.
Right.
So I think that stopped December 31st, 2023, if I remember. Is that correct, Rick? They put a halt to that?
Well, I'm not sure that's right, Tony, but what I would say is that, corporate strips were kind of I'm going to say popular, not highly popular, I guess, but, a somewhat popular thing to do. And one thing that is true is that capital gains taxation in general terms, as we've already said, is going to be at a higher rate now. So it's going to be at 33 1/3, where it was 25% before. That's going to drastically cool off the benefits that were available with strips. But, strips are kind of a wide-ranging thing too. It depends exactly I forget. Can you find that, who that was? And we can just say whoever it was asking. And they could call the appropriate person. We'll try to find it. Not that it really matters, but whoever it was, let's just say it that way. Whoever was asking, they could call. There we go. Okay. So anyway, they could certainly call one of us, and we'd be quite happy to discuss that a little bit more. Corporate stripping can mean many things, but I guess generally speaking, it's going to be much less beneficial than it was in the past.
After June 25th.
That's right.
All right, well,
All
that
right.
looks like, all the questions.
So, first and foremost, everybody that came, we thank you that you took time out of your day to listen to the presentation. Hopefully it was educational. Hopefully there's some things in there that made you think a little bit. Hopefully, if there is some action items that you think you need to take, and you're confident, it makes sense, yes, get in touch with your investor. Let's start doing these things. Let's start realizing, if you're concerned and you're not sure, as Rick said, get in touch with your DDL advisor. We're here to walk you through and sort of give you our opinions. We've eaten up, an hour and 20 minutes of your time. So I want to get everybody back out to, enjoy their dinners or whatever they got planned. But really, thank you guys for being part of the webinar. Any questions, email, phone calls, we'll respond right away. Time is very important here. Okay? Have a great day, guys.